Good morning, good afternoon, good evening to all the friends who've joined in across the world, across the various time zones. This is Harish Krishnan, batch of 2005 from the Indian Institute of Management, Kozhikode. Today, we have a very special guest, someone who evokes multiple responses. For most of us, he's an author, he's a professor whose books we have grown up with in our classrooms and pretty much sets our foundations of valuations, finance, etc. For many, he's an avid blogger, a thought leader in the investment world, and investment expert. And for those who are in the investor relations team, he sends them in a TC whenever he tweets about the company. We've all had, viewed multiple sessions on the net. Few of us have been fortunate enough to attend some of his sessions in person. And one such participant had this simple two words to say about this session: pure magic. So, with that, let me welcome this great magician, the guru of finance, Sir Professor Aswath Damodaran. Professor Damodaran holds the Kirshner Family Chair in Finance Education and is Professor of Finance at the New York University Stern School of Business. Professor Damodaran received a BA in Accounting from the Madras University and an MBA from the Indian Institute of Management, Bangalore, subsequently followed that up with another MBA and a PhD from UCLA. So it's a true honor and privilege from the entire fraternity of Indian Institute of Management, Kozhikode, to have you in our midst. Just to put some context, Professor has been teaching for close to about 4 decades now. Effectively, when I was in my kindergarten is when he first started teaching. So that should give some kind of perspective. The amount of wealth of knowledge that he will try and distill over the course of the next 90 minutes, initially through a masterclass, and then follow that up with a discussion on various aspects of finance. Professor, the floor is all yours. Thank you.
Thank you, Harish. Growing up reading my books makes me already feel old, and I don't think of myself as a guru. In fact, for some reason on CNBC, I got the title Dean of Valuation. I don't even know how that happened, and I'm still trying to live it down. But we have only 90 minutes. I'm not going to kind of wander all over, but I am glad to be with you. As Harish said, I am an IMB grad from 1979. It was at the time to date myself. When I went to IIM Bangalore, there were only 3 IIMs, A, B, and C, Ahmedabad, Bangalore, and Calcutta. And Bangalore was supposedly the IIM that would turn out MBAs or PGDMs for the public sector. Shows you how the world has shifted under you. That in 1979, there was actually an expectation that the Indian public sector would be hiring MBAs in large numbers going through. It's been a long time, and it's been a long journey. So over the next 40 minutes, I'm going to kind of give you kind of a summarized session of what I've actually been learning, unlearning, relearning over the last 6 months as this crisis has played out. But before I start on that session, there are a couple of general things to note about any crisis. I mean, I've been lucky enough or unlucky enough over my teaching lifetime to have lived through 5, 6, 7 big crises. The 1987 mini crash, the 2001 dot-com bust, the 2008 banking crisis, multiple Greek crises, the EU, every 3 years had a different crisis. But in every crisis, 3 things happen. The first thing is you lose perspective. During a crisis, you panic. You start to focus on what's happening right now, and that's human nature, right? The world is exploding around you. Who has the time to lift their eyes up and look at what's coming? So the first thing is you lose perspective. The second thing is you lose faith. Faith in what and everything you thought you knew, those fundamentals, those basics, they're abstractions. You lose faith. And third, you start reaching for experts to tell you what to do, outsourcing your thinking. And like you, I've gone through those stages in every crisis. And one of the things I've learned is I've got to force myself out of that morass of being caught up in the crisis. So I'm going to start by listing out some of the lessons I've learned in this crisis. Though some of these lessons I've known already, but I want to focus in on some of the lessons I've learned in this crisis. Some of the lessons are new, some are relearned. So here's the first one. As we've gone through these last few months, and I date this crisis back to February 14th of 2020, because that's the date that the rest of the world outside of China woke up to the fact of, oh my God, we have a virus, it's going to go global, and it's going to affect all of us. And during these last few months, you've seen markets go up and down. And as markets have gone up and down, people have complained. People have complained about how volatile markets are, how chaotic they are, how crazy they've become. And experts are willing to wag their fingers and say, look at these crazy markets. Look at what they're doing. Now, while markets have been volatile, think about what they're reflecting. They're reflecting the uncertainty that each and every one of us feels about the world. So while markets have been volatile, there have been lessons that markets have been delivering to us that have been willing to listen. We should be learning. So as you look at these last few months, the first thing to remember is in a crisis, markets play a pricing game. Let me explain what I mean by a pricing game. There are two words in finance we use interchangeably that we should not. One is the word value, the other is the word price. We know what drives the value of an asset. It's cash flows, growth, and risk. Of course, we can use a discounted cash flow model to capture it, but discounted cash flow models are new to the game. People have always understood the value of a business is driven by cash flows, growth, and risk. That's been as true as long as there's been businesses being bought and sold, which is there probably cave people who sold businesses to each other. What drives price? Very simply, demand and supply. What drives demand and supply? Well, it could be cash flows, growth, and risk fundamentals, but it's also affected by mood and momentum. In fact, in finance, for the last 40 years, we've developed behavioral finance, which is explaining why prices can sometimes wander away from value. That's a whole notion of behavioral finance. Behavioral finance is not about value. It's an explanation of why prices can deviate from value. So markets go back and forth between value and price, but during a crisis, markets become entirely a pricing game. When you think about what's different about a pricing game, there are three areas where price and value can diverge. First, value has an upper bound and a lower bound. Let me explain. One of the companies that has always fascinated me, that I've valued multiple times in my blog, is Tesla. So if you're an optimist on Tesla, you're going to have much higher expectations of revenues and margins and perhaps cash flows and a much higher value than me, but there's an upper bound on value. On the other hand, if I'm a pessimist on Tesla, there's a lower bound on value as well. I'll be much more pessimistic about revenues, margins, and cash flows, but there's a lower bound. Value has an upper bound and a lower bound. Price, on the other hand, has no upper bound and lower bound because it's driven by mood and momentum. Now, as some of you who've tracked Tesla know, the stock price has kept climbing and climbing. In fact, a couple of days ago, it's $1,700 per share. This was a stock that 6 months ago was trading at about $600 per share. It's tripled in price. And somebody asked me, well, what's the highest price Tesla can take? And my response surprised them. I said, there is no upper bound in price. It can go to 10,000, 20,000, 50,000. Price has no upper bound. I used to say price had a lower bound. You know what the lower bound in price is, right? I said price can't go below zero. In every crisis, you learn new lessons. And during this crisis, one of the lessons I've learned is price doesn't even have a lower bound. It doesn't get bounded at zero. And I'm going to explain this in a couple of minutes with a graph, but hold on to that thought. So value is an upper and a lower bound. Price has no bounds. Price is reactive. Value is proactive. Let me explain. When you play the pricing game, your job is not to decide what's going to happen in the future. It's look around you to decide what everybody else will be doing in the next moment. Remember the old Keynesian saying about stock markets? He described stock markets as beauty contests. And he said, your job in this beauty contest is not to judge who the best looking person on the stage is, but to decide who the other judges think is the best looking person on the stage. That's what you're doing in the pricing game. You're trying to decide what everybody else is going to do and get ahead of that. Value is proactive. To value something, you've got to look forward. You can't look backwards. It's been one of my pet peeves with the way valuation is taught in classes is we've made it a modeling exercise where we look at the last 10 years and we project things out. But true value is proactive. Price is reactive, value is proactive. And finally, price and value can be different numbers. But people who are value investors believe that value and price need to diverge. My response is why? There is nothing in this process that requires price to converge on value. Of course, you might have faith, and I do, that price will eventually converge on value, but there's nothing in the process that requires it. So value is upper and lower bounds, price doesn't. Price is reactive, value is proactive, and price may never converge on value. Hold on to those thoughts because I'm going to take you on a ride through this crisis. So you're going to get a big picture perspective on what's happened over the last few months to markets. Let's start with equities. And I'm going to focus on two equity indices, the S&P 500 and the NASDAQ. Very parochial of me, but I'll come back and look at global equities. But the S&P and the NASDAQ kind of capture what's happened during this crisis. As I said, I started the clock on this crisis on February 14th of 2020. That was the day that US and European equity markets woke up, and many Asian equity markets woke up to the fact that this virus was a global virus. It was going to affect the global economy. Between February 14th and March 20th, if you look at both indices, you see them both drop dramatically. The S&P 500, which was at 3380, an all-time high on February 14th of 2020, had dropped almost 35% to 2,305 by March 20th. But this is a crisis that's played out in two acts. Between February 14th and March 20th, across the world, equities were in free fall. Since March 20th, these same indices, these same markets have recovered a big chunk of what they lost in the first period. We'll come back and talk about what happened around March 20th that might have caused this turnaround. But this is a play in two acts. The first act, February 14th through March 20th, is a disaster. The second act has been more uplifting. Now, if you look at the crisis as it started with people selling stocks. But when people get into a crisis, there's a flight to safety. That's a fancy word for saying people get panicked, they sell risky assets, they look for something safe. And for better or worse, for the last few decades, that flight to safety has led people to buy US Treasuries. And between February 14th and March 20th, if you look at what happened to US Treasury yields as people bought Treasuries and pushed up the prices, Treasury yields dropped across the board, 3-month, 2-year, 5-year, 10-year, 30-year, across the board dropped. Now, when you ask people, why have interest rates dropped in the US, the answer you usually get is because the Fed acted. You know what? The Fed did not act till March 15th. Rates had already dropped before the Fed acted. The Fed did do things that changed the course of this crisis, but it wasn't on interest rates. Interest rates had already dropped before the Fed moved, and they dropped because people panicked and bought treasuries. March 15, the Fed announced that it was going to spend about $700 billion on quantitative easing, buying treasury bonds. On March 23rd, it followed up with the second announcement announcing that the cap at $700 billion was being removed, was willing to spend as much as was needed. But it also added a comment that I think played a big role in turning this market around. It announced it was willing to be a backstop in private lending markets, in corporate bond markets and bank lending. It actually announced that it was willing to spend hundreds of billions of dollars. You know how much money the Fed has actually spent? Almost nothing on this plan. But that announcement that we a backstop opened up private lending markets, in my view, played a big role in turning the global markets around. Now, as people panicked in those first few weeks and they pushed treasury yields down and treasury prices up, that panic was playing out in the corporate bond market. The default spreads on corporate bonds of every single ratings class had widened. In fact, take a BBB rated bond. On February 14th of 2020, the yield on a BBB bond is about 1.33% higher than on a treasury bond. That's a default spread people were charging for buying corporate bonds. Think of it as the price of risk in the bond market. If you look at March 20th, this is 5 weeks later, that same BBB rated bond had a default spread almost 3 times higher. Across the board, people are demanding higher prices for taking risk in the corporate bond market. No surprise here. This happened in 2008. It happened in 2001. Every time there's a crisis, people demand a higher price for risk. And you see that play out in the bond market. But as with equities, see what's happened since March 20th. You've seen the yields start to come back down. The default spreads have dropped back down, perhaps not to the level they were on February 14th, but towards those levels. So let's see where we are. Equities drop between February 14th and March 20th. Treasury yields drop. Corporate bond spreads widen. Now, there are two commodities I've tracked through this crisis. One is oil and the other is copper. Why these two? They're both economically sensitive commodities. And between February 14th and March 20th, if you look at copper prices, they were down about 16%, which makes sense, right? If you think the global economy is going to slow down, copper prices should drop. But take a look at oil prices. During those same 5 weeks, oil prices imploded. They didn't even just collapse, they imploded. They dropped by more than 50%. In fact, I'm tracking two different prices for oil. West Texas crude, which is the price of oil produced in the US, and Brent crude, which is the price of global oil. They both collapsed. In fact, on April 19th of 2020, you had that day when you woke up and said, I never thought this would happen. If you look at West Texas crude on April 19th, it went to more than minus $30. The price dropped below zero. But if you look even at the recovery that's happened since March 20th, and as with equities and bonds, you see a recovery since March 20th, copper is now back to where it was before the crisis, but oil is still down more than 30% in spite of the recovery since March 20th. So oil and copper reflect the fears that people felt about the global economy. And for better or worse, it seems to see the subsiding of those fears by June 12th. I also tracked two other items, gold and Bitcoin. Why gold? Because gold is a crisis asset of long standing. It's where people go when they're scared. And if you look at gold prices are up about 9% during this crisis. But in fact, many investors in gold have been a little disappointed that gold is not up more given the magnitude of this crisis. You see, why are you pairing Bitcoin? For better or worse, one of the sales pitches made for Bitcoin over the last decade is its millennial gold. What does that mean? If you're 35 years old, or 30 years old, or 25 years old, and you're panicked, you're not going to buy gold because that's what your parents and grandparents bought. You're going to buy Bitcoin. The story was, in a crisis, people will sell the paper currencies and buy Bitcoin. If that's a reason you've been holding on to Bitcoin, you've been sorely disappointed, because here's what Bitcoin's done during this crisis. It's behaved like very risky equity. And to explain what I mean by that, take a look at what Bitcoin did between February 14th and March 20th. While stock prices were imploding, Bitcoin prices were dropping even more. As stock prices have come back since March 20th, Bitcoin has come back even more. In fact, over this entire period, Bitcoin has behaved like a very risky asset. I'm not saying you shouldn't hold Bitcoin, but if the reason you're holding Bitcoin is as a crisis asset, it's definitely not done its job. Now, one of the things I've been doing during this crisis is every Friday when markets close around the world, I've been downloading the market cap data of every publicly traded stock in the world. Now, this is fairly easily done today. I mean, if I had to do this 40 years ago, it would have been impossible. But today, I wait till markets close on Friday, and then I download the data on about 40,000 publicly traded stocks. And then I group these stocks by region, by sector, by industry, by pretty much every classification you can think of. Because I want to get a sense of what's happening globally. So let's see how equities have played out by region globally if you go back to February 14th. So take a look at the last column, because this is going to give you the cumulative damage across regions of the world. Now, notice in every region, if you look at the last three columns, between February 14th and March 20th, you see the collapse in equities, down 30, 35%. In fact, the only market that was down less than 10% between February 14th and March 20th was China. And the only reason was down less than 10% is because the crisis started about 3 weeks earlier than February 14th in China, because everybody there knew there was a virus at play. If you look at the cumulative damage that's occurred between February 14th and June 12th, so this incorporates the recovery that's happened since March 20th. There are four markets that are down more than 20%. Three are emerging markets. One is Latin America, the second is Africa, the third is India. Okay? The only developed market down more than 20% between February 14th and and June 12th was the UK. And that might be Brexit still playing out there. It's like that crazy uncle who never goes away. So clearly, this crisis has had a much bigger impact on emerging markets, but even among emerging markets, the rest of Asia has done much better than India. I mean, I'm not going to draw any strong conclusions here because I'll let you draw the conclusions. But if you look at the equity damage across the period, you see it play out across regions. I've also broken down equities by sector, and take a look at the last column again. The best performing sector over this period has been healthcare. No surprises there. If you have a crisis caused by a virus, it makes sense that healthcare is one thing that will benefit from this. Technology has done well, and so have consumer products. For better or worse, what markets seem to be telling us is there's going to be damage from this virus to the global economy. It's not going to be long-standing. I'm not saying markets are right, but that's a judgment that's being passed. In fact, this sector breakdown also shows that the worst affected sectors include energy, no surprise there, oil is now down, real estate and utilities, big infrastructure businesses. But the worst affected sector over this period is financial services. Banks live in reflected glory and reflected pain. What I mean by that is when an oil company is unable to make its debt payments, guess who feels the pain? It's banks. So when you look at breakdown by sector, you get a sense of markets are not being indiscriminate. And you can see why I've described this as the most orderly crisis I've ever seen in my lifetime. It looks like chaos, but under the chaos, there's order. In fact, if you look at the breakdown by industries, and I break the sectors down into about 100 industries, and you look at the best performing industries, you see a lot of infrastructure companies, a lot of manufacturing companies, and financial services. You look at the best performers, technology and healthcare dominate. This is a crisis that has punished capital-intensive businesses and rewarded capital-light businesses, punished static businesses, rewarded flexible businesses. So if I were to sum up on markets, as you see markets being volatile, move around, they're a barometer of what we all feel. I tell people, look out of the window and tell me what they think they will be doing in 3 months. The answer across the world for most people is, I have no idea. Why would you expect markets to be any different? Second, even in the midst of these chaos, there is clearly order. This is a market that on the surface looks chaotic, but if you look under the surface, has been remarkably orderly. And early in this crisis, there was talk among some people that you should shut markets down until the virus passed. Thank God people did not listen. Liquidity is a salve during crisis. You need liquidity. You need people to be able to trade through. And thank God markets have been around for people to trade on their fears. So that's the first big lesson. People will tell you markets are crazy. Don't be so quick to agree with them because markets may look crazy, but under the craziness, there's been a great deal of order. Let's look at the second lesson. Whenever you have a crisis, you have experts come out of the closet. And many of these experts have agendas, and they push their agendas. And many of these agendas are data-free. So one of the things I've learned is when somebody tells me something, I need to check it with the data. So there are two things that I heard early in this crisis. The first was from old-time value investors telling me that this market drop was punishment for our sins over the last decade. What do those sins include? Well, we bought all those technology companies, right? We bought high PE stocks. We bought based on momentum. We were not being disciplined the way value investors wanted it to be. They wagged their fingers at us, especially in the first couple of weeks of the crisis. That we told you so. This crisis was a long time coming. The second was, at least in the US, there was a talk about this was a crisis that was brought to us because companies were doing buybacks. They pointed to the airlines and Boeing said, look, we told you so. You should not allow companies to do buybacks. And one of the things I've learned is when people state agendas, the best way to check them is by looking at the data. So I'm at least going to take the first pushback where people said, hey, we told you so from the value investors. You know, the old-time value investors, these are the guys who go to Omaha every year and pray at the altar of Warren Buffett, have had a tough decade. If you look at the history of value versus growth, buying low PE and low price to book stocks, which has been the traditional value investing route, versus high PE and high price to book stocks, the 20th century was clearly a century where value dominated. Then you got to 2010 through 2019. And you can see that for the first time in history, growth stocks outstrip value stocks by a significant amount. I mean, they kind of kept even between 90 and 99, but between 2010 and 19, growth stocks beat value stocks. This was the decade where Warren Buffett fell behind a lot of investors. No, Warren Buffett hasn't beaten the S&P 500 in almost 20 years. So when you look at this decade, value investors, of course, they said, look, this is just a bad decade. They blamed the Fed and they said, just wait for a crisis and you're going to see value investing win again. What is value investing? Buying low PE stocks with high dividends. Well, you have a crisis. Let's see how value is played out. I downloaded the returns on every stock. I broke stocks down based on their PE ratios on February 14th, from lowest decile to highest decile. The lowest decile include the stocks with the lowest PE ratios. Remember what value investors have told us. If they're right, the lowest PE stocks should have done much better during this crisis than the highest PE stocks. Take a look at the last column, and you tell me what the returns look like. You can already see that during this crisis, it's the highest PE stocks that have done the best, and the lowest PE stocks have done the worst. In fact, I also looked at momentum. It's the highest momentum stocks that have gone up the most, that have done the best. The stocks that had the lowest momentum, this has been a very perverse crisis. It's punished investors who've invested safely in low PE stocks with high dividends and low momentum. And it's rewarded people who've done all the wrong things. So value investors are celebrating. They're celebrating for the wrong reasons. In fact, I'll point to the one culprit in this crisis, the one thing that markets have punished. It's punished companies with a lot of debt. In fact, in this table, I've broken companies down based on net debt ratios from lowest debt to highest debt. So take a look at the last column. It's the companies with the lowest debt that have come out most unscathed from this crisis. This is a crisis that has punished companies that have loaded up on debt. So bring it all together. This is a crisis that's been tough on capital-intensive business. It's been tough on companies that have borrowed a lot. But in effect, you see that play out in terms of the returns you've seen on this crisis. So here's my bottom line on value versus growth. If this is the crisis that value was supposed to shine, it's clearly failed, this crisis does. So if you told me to buy low price earning stocks with high dividends and I listened to you, I've been punished during this crisis. But in my view, old-time value investing has lost its way. For those of you who read Ben Graham and Warren Buffett, I think you might need to rewrite your script, because old-time value investing has become very rigid in the way it approaches investing. It's become very ritualistic in what you're supposed to do. And it's become very righteous in terms of feeling entitled to earning higher returns. And if there's a hope for value investing, it's in redefining value. I think of myself as a value investor, but I would not go to Omaha. I don't read Ben Graham's security analysis on a daily basis like a Bible. I believe I can find value in high growth companies. I mean, I bought Tesla in June of 2019, the exact opposite of a value investor script, right? So I feel that I can find value in high growth stocks. To me, the definition of value investing is you buy something at a price lower than the value. Nowhere in there does it say I have to buy only mature companies. So we might need to have a more dynamic view of value. One of the things I looked at during this crisis was young versus old companies. Now, some of you might know I do a session on corporate life cycles. I think companies are born, startups, then they grow, they're teenage companies, and they become height of their life, then they become middle-aged and they age. So one of the things I've been watching during this crisis is how the crisis has punished or rewarded companies at different stages in the life cycle. Now, you can say stories about how crises should affect companies at different stages in the life cycle, but here's how it should play out. Young companies should be impacted during a crisis because they can't raise capital. Remember, young companies need capital. Older companies get impacted by a crisis because it affects the investments they've already made. And during this crisis, again, you've seen a very perverse game play out. In most crises, young companies suffer more than older companies. In 2008, for instance, young companies lost more of their value in the last quarter of 2008 than mature companies. In this crisis, it's been different. It's older companies that have been punished more than younger companies. No, and if you look in terms of growth, it's high growth companies that have done the best during this crisis. Young companies with high growth have emerged pretty unscathed from this crisis. Older companies with low growth have been punished. And the reason I think is very simple. During this crisis, risk capital has stayed in the game. What I mean by that is in the last quarter of 2008, you know what happened to IPOs? They dried up. There was one IPO. You know what happened to venture capital? There was nothing. In this crisis, venture capital has stayed in the game. Public equity invested in high growth companies have stayed in the game. IPOs have remained intact. This crisis, for whatever reason, you've seen capital stay in. And perhaps the reason for that is how this crisis has played out. In most crises, here's what you see happening. You see markets start to implode first, and then the economy slows down. Remember 2008, it was a market implosion that came first, the economy slowed down. This crisis, the economy shut down around the start of March, but markets were actually pretty healthy at the time the crisis hit. And the clock came with a timer, right? They told us, and they were lying, that the economy would open back up by the end of June, at the end of May, and we believed them. But private risk capital has stayed on during this crisis. People have been able to raise capital in equity markets and from borrowing. Venture capital has stayed in the game. IPOs have stayed in the game. And that's led to how the game has played out. So second big lesson, when somebody tells you, that something is true about the market, check it with the data. The data is there now. Third lesson, for 45 years, I've been told there's smart money and stupid money. As long as I've been investing, I've been told there's smart money out there and stupid money. And you know what smart money does, right? It gets into markets before everybody else does, before they start rising. It gets out before they start falling. It buys the right stocks and it sells the right stocks. Stupid money does emotional things. It's uninformed. And at least the way this plays out is smart money is supposed to be professional money managers, hedge funds, the people who write books about investing. Stupid money is retail investing. And for 45 years, I've searched for smart money. In fact, I have a paper coming out called Where's the Smart in Smart Money? Because I haven't found it. Because if you look at smart versus stupid money, it plays out in a very simple choice. So remember, smart money tries to decide when to get into markets, which stocks to buy. Think of it as active investing. So if you are either an active investor, you pay somebody 2 and 20. Remember, that's what hedge funds charge for investing. You're an active investor. For much of the last 40 years, you have had a choice. You can either pay somebody else to manage your money, you can buy index funds. In the last decade, you can buy ETFs. And over the last decade, this contest has become a very unequal one. And you know who's winning? Passive investing has been winning. For much of the last decade, money has been flowing out of active investing, out of mutual funds, out of hedge funds, into ETFs and index funds. And of course, again, active investors have had all kinds of excuses. Prime excuse was, hey, it's the Fed doing it to us. And they told us to wait for a crisis. They said, you're going to realize how much you need us during a crisis. Well, they have their chance now. Let's see how active investors have done during this crisis. I'm going to update this because the second quarter numbers are just starting to come in. But I took a look at how active mutual funds in the US have done during this crisis relative to index funds. Remember, many of these index funds you can buy without paying any money. It's almost free to invest in. In 7 of the 9 categories that Morningstar tracks, active mutual funds have underperformed indices. In fact, collectively, active mutual funds have underperformed indices by about 1.37% during this crisis. So if this was your chance to shine as active mutual funds, you've not delivered. Now, of course, if you talk to a hedge fund, they're going to say active mutual funds, they're run by stupid people. Hedge funds are the smart guys. Well, they've had their comeuppance as well. In fact, it's been very humiliating to be a hedge fund manager for the last few months. Because over the last few months, you got a phenomenon called the Robinhood phenomenon. For those of you not familiar with Robinhood, it's an app. It's an app used by traders and gamblers. I mean, in fact, it's used by people who used to bet on fantasy sports, fantasy football. They've decided that because sports have shut down, they're going to bet on stocks. And over the last few months, a very strange phenomenon has played out. People have tracked what stocks that these Robinhood, remember the people investing in this Robinhood app are people who have absolutely no experience investing. They're the proverbial monkey throwing dots at a dartboard, and they've been beating hedge funds. It's been incredibly humiliating. In fact, I've heard this big run-up we've seen in stocks as the most hated rally in market history. It's hated by all these professional investors because it's revealing how empty their choices have been. I'm not suggesting Robinhood traders are great investors. In fact, they remind me of people in casinos who've made a lot of money by 11 p.m., but they keep playing at the casino. You know what's going to happen by 6 a.m.? They're going to be poor again. So many of these Robinhood traders are going to lose everything they've won. But over the last few months, they've actually beaten hedge funds in terms of stock picks. So I'm going to suggest a different classification. I don't believe there's such a thing as smart money. So if you ask me, would I trust somebody to manage my money? I'm going to say probably not. But if you force me to pick somebody to manage my money, I want somebody who's humble, not arrogant. Here's what humble money does. When it succeeds, it knows that a big reason for its success, it was in the right place at the right time. It's luck. And when humble money fails, it looks for reasons, mistakes it might have made. In contrast, arrogant investors, when they win, it's because of their skills, their amazing way of picking stocks. And when they lose, if you notice, it's always somebody else's fault. I want to put my money with somebody who's humble, not somebody who's arrogant. A few months ago, in fact, towards the end of 2019, I wrote a post on SoftBank. I wrote it because a few months earlier, I wrote a post on WeWork. And those of you who read my WeWork post, I noted that WeWork had been run by perhaps the most arrogant person I'd ever seen running a company. A guy called Adam Newman. A guy was arrogant enough that he actually, in the corporate charter, wrote in that his wife would pick a successor in a public company. What is this? I mean, how do you get away with this? But he was arrogant enough that he thought he could get away with it. But of course, his biggest backer was SoftBank, which is run by a guy called Masa Son. You're saying, what's the big deal with Masa Son? He has a 300-year plan. That's a height of arrogance. To me, this was arrogance doubled. I said, arrogant money backing an arrogant company. So I said, look, now I wouldn't trust SoftBank to manage my money. And I'd say the same thing about any investor who believes that they've got the answers. You want humble money, not arrogant money. I'm getting towards the end of my slot, so let me close off with a couple of final points. During a crisis, you're told that the fundamentals don't matter. And I'm going to emphasize something I've learned the hard way during crisis. More than ever, the fundamentals matter. Let me explain. I've been valuing the S&P 500 and other indices off and on for most of the last 4 decades. And I always value them the same way. You take expected cash flows on the index and you discount back at a required return on the index. A required return for an entire index is composed of a risk-free rate plus an equity risk premium. The cash flows will come from dividends and buybacks growing at some rate in the future. So that's how I value the index at the start of this year. And then, of course, the crisis hit. And once the crisis hit, I was told the fundamentals don't matter. And of course, right now, people are saying markets have gone crazy. How can the index be going up when we're facing all this terrible macroeconomic news? And there are quite a few people who claim that this market is in denial, that it's not seeing the damage that's coming. And you might be completely right. So here's the first thing I want to explain. There is a reason why markets and economic news are disconnected. It reflects the role that markets play. This is a graph where I look at quarterly returns on the S&P 500. That's a green line. And the GDP, the red line. And the green line is the real GDP growth each quarter. Take a look at the correlation between stock returns and real GDP growth and economic news in the same quarter. It's close to zero. There is almost no correlation between what stocks do and what the economy does in the same quarter. But if you look 1 quarter ahead, 2 quarters ahead, 3 quarters ahead, 4 quarters ahead, you see that correlation start to climb. The market's role is to be a predictor of what the economy is doing. For better or worse, what the S&P 500 and what global equities are doing is trying to predict what the global economy will look like 4 quarters from now. Now, don't get me wrong, that correlation is still only 0.28. Markets can be wrong, but that explains the disconnect. One of the things, and this is not in your slides, I track the price of, remember I showed you the price of risk in the bond market? I track a price of risk in the equity market by day during crisis. And during this crisis, if you look at the equity risk premium, the price of risk in the US equity markets, and the price of risk I use for mature markets, started at 4.8%. On March 23rd, that number was 7.8%. And by the end of the crisis, it was back down to almost where it was before the crisis. So about 4 weeks ago, 3 weeks ago, start of June. That was more than 3 weeks ago. I valued the entire index. I did it because people were telling me markets were crazy. And I valued the index going back to the same fundamentals I've always used. So I projected out earnings and cash flows. I projected out the damage that would be long-term. And I projected out an equity risk premium. The value that I got for the index based on my fairly pessimistic projections for 2020 and 21 was about 2,930. The index was trading at about 3,030 when I did this, within 4% of what my value was. The point I was trying to raise was, don't be so quick to call the market crazy. There is actually a plausible story, perhaps even a probable story I can tell to justify where markets are today. Of course, this will mean accepting lower returns on stocks going forward than you've earned historically. But when you can earn only 0.7% on a risk-free investment, you should be willing to settle for 6% on stocks. In fact, one of the things I do when I'm faced with uncertainty is I use what I call Monte Carlo simulations, where I let my assumptions play out in distributions. So I took my assumptions for the index, and you can see my distribution of value for the index. It's good to be humble. I know I'm going to be wrong and horribly wrong in my valuation. And I don't try to time markets. But my point is, when people tell you markets are crazy, markets are overpriced, markets are irrational, they need to take a look at the mirror. Because that's a height of hubris to go around saying, I'm the only sane one. The rest of the world has gone crazy. And I don't like to use words like bubbles. Because when you say bubble, you've already tarred and targeted those people who are buying stocks as crazy. You need to always leave the door open to the fact that you don't know what the market is building in. And it's good to be aware of it. I've always told people, I believe markets make mistakes, but I will always respect markets, because if you don't respect markets, markets will take you down. Final point, and then we'll end for the day. As some of you know, I'm a great believer that a good valuation is a bridge between stories and numbers, that it can't just be an Excel spreadsheet, that behind every valuation, there's a story. And in fact, I have a 5-step process that I use to value a company. And those of you who want to learn more about this, I have an entire 1-hour Google talk where I go through this 5-step process, where I start with a story. I check to make sure the story is not a fairy tale. I convert the story into drivers of value and convert those drivers into a value. And then I leave the feedback loop open, knowing that my value can be wrong. I used this process in January 2020 when I valued Tesla. I valued Tesla because in June of 2019, as you know, I valued Tesla and I bought Tesla for the first time. And I got incredibly lucky. And I know it was pure luck. I got the timing right. The value went from 180, which is where I bought it, to 640. And in January, I revalued it about 427 and I sold the stock. I know. I left a lot of money on the table. It's now at 1,500. I have no regrets, though. I have to dance the dance I came to dance, which is I believe in value. And believing in value, I thought it was overvalued in January 2020. My point, though, is I told a big story about Tesla in January 2020, and I converted that story into value. In my big story, I saw Tesla become one of the 10 largest automobile companies, revenues of $127 billion, with margins like those of a successful tech company, not an automobile company, because auto companies don't have great margins. So even with this expansive story, the value that I got was $427. My point is the story drove my inputs drove my value. And of course, when you have a crisis, people say, well, you can't tell stories anymore, right? More than ever before, I need to draw on stories, my value companies, because the dark side will beckon. You know what happens to the dark side? You're told the fundamentals don't matter. You can't value companies anymore. That is not true. More than ever before, I need to go back to basics. In fact, I built a spreadsheet in March of 2020 after the crisis started, precisely because I wanted to go back to fundamentals. I didn't reinvent the wheel. I stick with the fundamentals, but I separated 2020, which is going to be a terrible year for most companies, from the rest of time. In fact, I'm going to close with a slide because last week I revalued Tesla. Remember the value of 420, about $430 I got before the crisis? It's now gone up to 628. You're saying, what happened? Well, the crisis happened. In a strange way, I think Tesla is going to benefit from the crisis because its competition is capital intensive, debt laden automobile companies. They're all incredibly handicapped by this crisis. Just like Amazon coming out of the dot-com bust, in 2001, that created Amazon, the company you see today. Tesla has a chance, and that chance is going to make it a more valuable company. I still can't get to 1,500, but my point is I'm still telling stories. I'm still valuing companies. So don't give up on the basics. Be willing to tell stories and look uncertainty in the face. We have the tools to deal with it. We have the data to deal with it. Your biggest enemy in this process is you. So if you can get over that psychological hurdle of feeling uncertain, feeling uncomfortable, and make your best judgments, you can still hang in there. That's about all I wanted to say. So I'm going to open up for any questions you might have sent in. So I'll turn it back over to Harish. Thank you.
Wow, this truly was the masterclass. Such amazing insights. In fact, if I were to go back to the start or the title of the slide, Serenity written there. And to me, it reminded me of the Seinfeld episode, Serenity Now, Insanity Later. To me, the biggest takeaway, as you rightly pointed out, when in doubt, go back to first principles. Don't doubt that, and be calm, be objective, and things will just fall into place. So thank you, Professor. Truly enriched all of us by your thoughts on the contemporary markets. As you know, Professor, it's an amazing honor, and the very fact that we kind of pre-announced it. There was a deluge of questions, close to about 250 odd questions that came up to me in a span of 24 hours. And I know I'm going to disappoint almost 90 or 95% of them. I'm sure I'll have more enemies than friends. But what I would like to do now is, go through the valuation framework that you laid out. Bring into context various aspects, and then we can try and glean some more insights from yourself. The first question, Professor, you spoke about DCF as the fundamental pillar of your valuation. I would like to know, from a reverse DCF, and you did give an insight of equity risk premiums that you back calculate and then you give it. Just interesting to kind of understand. And you also spoke about the narrative, the fact of the three Ps. Possible, probable, plausible, and probable.
Mhm.
I'm just curious. When you do a reverse DCF, is that a sanity check even for a stock level? That kind of throws out, the complete reverse of it. Impossible, implausible, and improbable. And could you give some examples out there? Thank you.
There's two things. One is I would suggest a book that actually is built around that premise called Expectations Investing. It's a book by Mike Mauboussin, who's one of my favorite people to read. So basically, the entire book is built around the premise of, hey, you can reverse from a DCF what the market is expecting, with a caveat. Think of the DCF as an equation with multiple variables in it, right? Your growth, your margins, your reinvestment. So you have dozens of inputs you have here. The problem is when you do a reverse DCF, you can pick only one of those inputs to be your uncertain input. In other words, you can solve for only one variable in this equation. So if you do a reverse DCF, you've got to pick the variable that you feel most uncertain about. That actually is the biggest part of doing a reverse DCF. Let me explain. Let me use Tesla as my kind of example. I talked about my big assumptions about expected revenues in the future. How big will revenues be in year 10? What will the margins be like in year 10? What will the reinvestment look like for Tesla to become a large company? I can pick only one of those three as my reverse DCF question. I can't say I'm going to let all three be uncertain, because you can't solve with one equation for three unknowns. I'll tell you the variable I would focus on. To me, the biggest unknown with Tesla is what its expected margins will be, because I think Tesla can pull off becoming a big company. I think Tesla can pull off being pretty efficient about delivering those revenues. You know what Tesla has not shown me yet? That it can actually make substantial margins. So to me, the biggest unknown with Tesla is, can it actually deliver those 12, 14? Because if it can deliver Microsoft-like margins, Microsoft has 22% margins, you can actually justify a $1,500 stock price. So if you're buying Tesla and you're buying it for the right reasons, maybe you have a story that explains to me why it can have 22% margin. So if you back out from the current stock price, what the break-even margin has to be, it has to be about 21%. So maybe there's a story that you can tell me that's a plausible story. But Tesla stopped selling cars but starts selling software. It's actually a plausible story. And it came to me while I was listening to somebody who owns a Tesla. He actually had bought a used Tesla. And I asked him how, Teslas come with autopilots, right? So basically you can put it on auto drive, and there have been some stories. So I asked him how he liked the auto drive option. And he said, I can't use it. And I said, why not? He said, to use it, you need a software download from Tesla. And because I bought it used from somebody and it was not authorized by Tesla, I cannot download the software. Which actually raises a very interesting question. Without the software, a Tesla just becomes a hunk of metal in your garage that cannot move. So I'm not saying that this is going to be the model, but what if Tesla can produce an auto body that you just have to download software for every 2 months to keep going? And software is a huge margin business. So maybe that's the story you can tell to justify the Tesla valuation. But it is true, you can reverse engineer from a DCF whatever variable you're most focused on. But be careful about which variable you pick. Now, that's why I do the Monte Carlo simulations, because there I can let everything become uncertain.
Right.
Because the variables are connected to each other.
Right. That's a great insight, Prof, to focus on the most uncertain variable. I think getting that right is possibly 70 or 80% of the job done. Prof, if I can just switch gears, and one of your slides, you spoke about the longevity of companies, and in some sense, it's doing what Corona does, that is impacts elders more than the youth. Clearly, the younger companies seem to be the ones that the market believes at least will prosper out of this crisis far more than the older companies. Now, there are two observations that have come here. First, from an IMK student, Neil Oswal. For decades, businesses with stable cash flows have commanded premiums. But today's mantra is more like, first let's capture the mind share, or rather, first start with the customers, capture them, then the mind share, then the market share, and then, if at all, let's focus on the profit share. And the second observation is from Kavish Thakur. He has this interesting observation that he makes that today companies have access to vast pools of private capital, which wasn't the case, many decades ago. You did point out, of course, of a extreme pool set of 300 years horizon that Maso-san had, but that SoftBank has. But in this kind of an environment where you have such huge pools of private capital, is it actually a disadvantage to be listed? Or put it another way, is it actually a big advantage to continue to remain unlisted? Have access to all of these pools of capital, don't really have to worry about quarterly numbers, etc. Just want your perspective on this. Thank you.
Let's take that in two parts. I mean, let's start with the first part, and I'm going to challenge the premise of that part. Because the premise was that you said for decades, mature companies with stable cash flows have demanded a premium. I don't think that's true. In fact, if you look at that table I showed you of price earnings and price to book across the decades, the low PE and low price to book stocks earned higher returns. You know what that means, right? Upfront, they were actually priced lower than they should have been. So in fact, the
Right.
opposite has been true for the longest time in history, which is we paid too high a price for companies with unstable cash flows and low cash flows and too low a price. In fact, the last decade,
Mhm.
it's actually been it's only the last decade
That's
that
right.
you've actually seen the opposite to be true. So I think maybe that's coming from an Indian context, which is in India, perhaps companies with stable cash flows and predictable earnings have
Right.
had higher PE ratios. But in India, you also have a mess of corporate governance issues that go with companies, right? And if you have corporate governance issues, you know what? You want to invest in companies where you can see the cash flows up front because you don't trust growth companies, not because they can't grow, but because you don't think you get a fair share of the growth. The game has been cooked. So I think that's so the first premise that traditionally mature. But I'll kind of deal with the question of has the world changed? I think it has in the following sense, which is I did a session on the tech life cycle, the life cycle of tech companies. Remember the corporate life cycle graph I showed? And I
Right.
described tech
Right.
companies as aging in dog years. And what I mean by that is if you look at the great companies of the 20th century, the GEs, the Fords, the Daimlers, the Siemens of the world, they lasted 100, 120, 130 years. You look at a company like Yahoo, a superstar company in the late 1990s, comes out of nowhere, starts in 1992, by 1999 becomes a $100 billion company, peaks by 2003, and then implodes and disappears by 2015. Start to end, the entire life cycle lasted only 23 years. The companies of the 21st century are going to look more like Yahoo than they are going to look like GE. And that has consequences for so much of what we do in business. I'll give you a very personal example. In DCF, when you're asked to value a company, you follow the textbook. What do? You project cash flows for the next 10 years. And beyond the 10th year, you assume a growth rate forever
Terminal
and you
value.
compute a terminal value, right? And if you have a life
Right.
cycle that lasts 70, 80, 90, 100 years, the way you justify it is you say 70, 80, 90 years is very much like forever. So using the perpetual growth model gives me a value pretty close to what I've got. And that worked for the
Right.
GEs, the GMs, and the Fords. But let's say you're valuing Zoom. You project cash flows for the next 10 years. You give it this huge growth rate. Remember, the companies of the
Yeah.
21st century can scale up really fast. Then you get to the end of
Right.
year 10. Are you going to 2% growth rate forever? I mean, what technology lasts forever? So, in a sense, with DCF, you can't assume a 2%, but that doesn't mean you abandon DCF. You know that in a discounted cash flow model, in your terminal growth rate, when you get to the terminal value, you can use a negative growth rate forever. We almost never do, but there's nothing technically that stops you from using a minus 5% growth rate forever. Saying, what will that do to my
Okay.
company? It'll peak your company in year 10, and over time, your company will disappear, which might, in fact, be closer to the truth than using a 2% growth forever. So when I say go back to basics, I think we need to be more flexible with the basics. What often people, when they talk about go back to basics, they go back to the DCF model and they keep it rigid. The
Right.
DCF model is an incredibly flexible model. We need to be willing to test that flexibility more. So I think that that with these companies of the 21st century, we need to be more dynamic, more flexible in the way we use models. But I do think that the premiums that you will pay for the big money-making companies of today, which are primarily big tech, with the big tech companies,
Yeah.
will
Big
not
tech.
last for as long as the premiums you paid for the Coca-Colas and the Kraft Heinz of the 20th century. As for the private risk capital, I think you have a point about that pool being deeper than it was before, because it's not just the SoftBank vision funds that are supplementing the pool. It's public equity is part of the private equity pool. You know that T. Rowe Price and Fidelity have invested in Uber as a private
That's
company.
right.
That said, though, you know how dependent private equity risk capital is on public equity markets staying healthy? And I tell people, look, if you see the NASDAQ dropped by 50%. I can guarantee you private equity capital will dry up in a second. These hundreds of billions of dollars you see out there are there because public equity is so healthy.
Public funds.
It's
Right.
a it's a market that lives off public equity because what's your exit strategy as a private equity strategy? It's not to build a
Right.
company, it's to flip it to somebody else or to take it public. So much as it looks like these companies can survive without public equity, if public equities collapse, Oyo is dead in the water. I don't care how much capital the Vision Fund claims to have, Oyo will not make it if public equities collapse. So guess what? Private equity is a transient game. It survives because public equities are healthy. So that market that dries up. If the public equity market dries up, private equity will dry up in a second. I saw it happen in 2001. Or VC money, which
Sure.
was tens of billions of dollars in the 1990s, dried up overnight. It was gone. So if you're a private equity player, hope and pray the public equity markets stay healthy because without it, you're not going to make it.
Fascinating point. Uh, in fact, coming back to your presentation, wherein you said that the risk capital came back quite
Yeah,
fast and it never
it
went
never
away.
went away. In fact, it didn't
It
even
never
go in
went.
the first 5 weeks.
That's right. Partially, it could be because the central banks kind of raised the bar way too early compared to what they did possibly in 2008. So in that sense, possibly the cycle is still in the works. We've seen some kind of, I'm saying from a market perspective, forget the business and the health cycle. Do you kind of think that therefore that as downgrades keep happening on the bond side, we are actually going to see some kind of risk capital
Oh, this
no?
story is not complete yet. I mean, that's why I keep doing these
Okay.
updates, saying each week, I say, I'll be maybe next week, maybe next week. I
Okay.
mean, this story is still unfolding. I mean, there are more chapters to be written, and some of those chapters are going to be pretty dire, bad chapters, and some are going to be good chapters. There'll be downs, there'll be ups, and so I think that there's a lot more left in this game. In fact, my current post that I'm writing on is on this topic of what is it that's allowed private risk capital to stay in the game? What's different this time around? Because it disappeared in 2008, disappeared in 2001. In fact, in every crisis in history, private risk capital has disappeared. One is, of course, is this central bank put. The Fed has put a put on a downward protection, and maybe that's making risk capital be more daring. The second is, I think private risk capital is more diverse than it used to be. There was a point in time when private risk capital meant Silicon Valley venture capitalists. That's no longer true. It's a global game. There are multiple players in the game. It could be that the game has changed with new kinds of investors entering the public equity market. People like these Robinhood app and traders who wouldn't have had a chance 20 years ago. I think it's a multitude of factors. I don't think it's any single factor, but it's for the moment, it's true private risk capital here. But you're right. It could very quickly turn if there are far more. It's not just downgrades, it's defaults, right? It's downgrades are downgrades. Defaults are what scare people. So if you have defaults that spill over into banking crises, that spill over into more defaults, then you have a true crisis on your hands. And there's still a very real possibility that could happen. So I'm not saying markets have predicted the world is going to come back, so the world's going to come back. Remember, the correlation is only 0.28, even 4 quarters ahead. There's a lot that markets don't know, but they're the same things none of us knows.
Professor, we spoke about debts and you said about downgrades aren't important, defaults are. Just want to shift gears into the debt portion, and we keep speaking about bubbles in fintech and tech world, etc. We kind of miss out that the biggest bubble possibly is the bond market, where we've seen almost 40 years of secular decline in yields. The bond markets have kind of reflated back from the crisis that they saw in March back to all-time high levels and with more debt. So I just want to understand, what really is the end game for all of this debt that future generations may have to honor? How does this kind of end? Some thoughts on that will be
Yeah.
helpful.
But first, I mean, I think there is a story that companies have become more levered over the last decade. Remember what I said? Everybody has an agenda. One of the agendas I've heard is
Mhm.
companies are borrowed like crazy. So one of the numbers I track is the net debt to EBITDA going back in time. That number hasn't changed since 2005.
Changed. Yeah.
So basically, what you have is people are borrowing more money, but they're borrowing because collectively companies have more cash flows. And the question to ask is how much will that EBITDA be damaged because of this crisis? Because let's face it, it's going to deliver damage this year and next year. And how much will debt need to come down? I'll be quite honest, there are sectors that are over levered. And we know telecom is over levered. And you know why they're over
Right.
levered? Telecom companies borrow money. And if you ask them, why do you borrow money? Their answer is because we need to invest in infrastructure. That doesn't answer my question. You can raise equity and invest in infrastructure. So why do you think they borrow money? You know why they borrow money? Because 100 years ago, AT&T borrowed money to build a phone. We forget how much of corporate finance is driven by inertia and Me Tooism. So if you ask telecom companies, why do you borrow money? It's because everybody else borrows money. Why does everybody borrow money? Because that's the way it's always been. And that, I think, has gotten sectors in trouble. I've never understood why airlines borrow money. You have a business that's already heavily, weighed down by fixed
Leveraged.
costs. Why would you
Right.
add on debt on top of it? And the answer is because that's what we've always done. But the world has shifted under you. AT&T was able to borrow money to build its infrastructure for a simple reason. It was building into a monopoly, which is it could borrow the money, pay the interest expense, and pass it on to its customers. What telecom company in the world today is building into a monopoly? You're now a technology company. You should be borrowing like a technology company. So I think this isn't a market-wide problem, but it's a sector-specific problem. I hope what comes out of this crisis is airlines and telecom companies take a look at what they're doing and saying, maybe we shouldn't be borrowing money. And hopefully this lesson will not be delivered will not be delivered with a lot of pain, because the pain will be if three big telecom companies go bankrupt. I don't want that to happen, because then you have side
True.
costs. But I hope CFOs wake up to the fact that the way they've funded their operations doesn't have to be the way they fund their operations in the future. So I think that when we talk about debt, I think we've got to be specific about what sector we're talking about. Because let's face it, you look at the technology sector, which is where the bulk of the market cap rises, it's very likely levered.
Right.
You take Apple, Facebook, Amazon, these are companies that don't borrow money. Yeah. And Netflix, if it has debt-like features, because of the content commitments that they have, which is a very different question about that kind of
Sure.
business model. So I think that it's been a long ride in bond markets upward. And that ride is not created by what's happened in the corporate bond markets, but the fact that rates have come down. But you know what? Rates
Right.
coming down reflect an underlying reality. We live in a world which I think is going to have lower growth and lower inflation than the world we saw 20, 30, 40 years ago. So when you do your DCFs, be very careful about that growth rate in perpetuity. Because low interest rates are a gift that gives, but they're also a gift that takes away. They make your discount rates lower, but they also make your expected growth rates and your expected cash flows lower.
Understood. And of course, in India, we've seen you mentioned about telecom, and we've seen possibly the greatest deleveraging story out in India, where what in a matter of 2.5 months, they've raised close to about $20 billion from all kinds of companies. But Professor, if I can just deliberate a bit more on the debt side, you're right. Corporate debt hasn't really gone up, but it's clearly been the sovereigns that have raised all this amount of debt. And of course, the starting point of arriving at the cost of capital is really the sovereign rate or the risk-free rate, so to speak. Just try to understand, at what point do you get a sense that this is unsustainable? We can't be having whatever 0.6 or 0.5 as say the AAA rate in US, etc. Or do you think that inherently let the market be right? Why should I second guess and kind of predate that move? What camp are you in, and how do we resolve that?
You
Thank
don't
you.
have to have a camp. You can be in both. And here's how. I mean, today,
Okay.
the rate is what it is. I mean, you got to take a karmic view of rates. This is not your rate, my rate. We might believe the rate's too low, but the reality is if I don't buy Tesla, and I decide to put my money in something risk-free long-term in US dollars, guess what I'm going to make? I'm going to make 0.7%. It's not
Right.
an estimate. It is a fact that for the next 10 years, if I want to lock up my money, I'm going to earn 0.7%. But at the end of year 10, I get to my terminal value calculation. I get a chance to revisit the question of what will my risk-free rate look like once I got my principal back at the end of year 10. So let's say I believe that a fair rate for the US dollar is closer to 3%. Think of it as a normalized rate. I can make my risk-free rate after year 10 3%. What will that do? It will raise my cost of capital after year 10. But it comes with a bonus. If the risk-free rate is 3%, I'm living in a very different, higher inflation, a higher growth. The growth rate I will use in perpetuity can also be up to 3%. On the other hand, if I leave my risk-free rate at 0.7%, it's true my discount rate will stay low in perpetuity, but my growth rate in perpetuity is also going to be capped at 0.7%. So you look at the spreadsheet I've built in March of 2020, I let people change the risk-free rate, but when they change the risk-free rate, I also change the growth rate in perpetuity. And guess what happens? My final value doesn't change very much based on my views on rates. And that's my point about rates, is we're so obsessed about rates being low and trying to fix it. We forget about the company. We take our eye off the ball. If you're asked to value Tesla, you should be spending 95% of your time thinking about Tesla, not thinking about the Fed and rates. And unfortunately, when you have macro obsessions, what happens is you forget about your company, you let your macro obsessions take over. So I think rates are low. I think they're too low, but at the same time, when I value a company, they are what they are. I've got to live in the world I'm in, not the world I wished I was in. And I see a lot of analysts living in the world they wish they were in. The world we're in is low rates and low growth and low inflation. And I'm going to build that in.
That's quite a telling remark on the whole lot of us practitioners who try to live in our own bubble, our own world. Fascinating, Professor. Again, sitting on the debt side of the valuation side, we've seen again corporate bond yields. And say the dividend yield. I'm taking AAA corporate bond yields and say the dividend yield of S&P 500, almost at parity. Now, as a purist, it seems quite silly and absurd because in equity you have the option value of the future cash flows and the option value of growth. So. If do you at all get into this entire thing of which asset class is more mispriced at any point of time? How do you kind of resolve that when it comes? Again, it's a macro question. I know you said we shouldn't spend so much time there, but would love to hear your thoughts.
Are you telling me that corporate yield, the dividend yield is too low, or the risk-free rate is? I mean, is this an argument that the dividend yield is too high, or the risk-free rate is too low? I mean,
It looks like the corporate yields are too low. That at least for AAA rate.
Or the corporate yields on the AAA versus the dividend yield?
Dividend yield.
But
that's right.
That's an interesting question, right? Because I think that there's nothing in theory that requires the two to kind of move to parity. You're saying, I get the upside with stocks. Why shouldn't I just put all the money in equities rather than corporate bonds? I mean, both are born, the underlying number that drives both is the T-bond rate. Corporate yields are low because the T-bond rate is 0.7%, right? Because you build a default spread on top of that. So you're earning about, right now, if you're, let's say, a BBB rated bond, you're earning about a 2% default spread. BBB rated bonds have about a 1% default rate. So you're pretty much going to earn roughly 2% on your portfolio. Guaranteed. Almost guaranteed. You invest in a dividend yield of the same amount. We live in a world where all those dividends are 2019 dividends. Your dividend yields right now are dated, right? Because they don't reflect the pain that's coming to dividends this year. Because the dividends are a lagged effect. So to begin with, those dividend yields are higher than they truly are because they don't factor in the cuts in dividends that are coming. And second, remember we talked about life cycles? The dividend yields you see could be here today, gone tomorrow. That's the other thing we need to relearn from history. Historically, we assume dividends are like coupons. We can keep collecting those dividends. Hey, guess what? Those
Right.
days are starting to get dated. In the US, it's already happened. The US, increasingly, companies have shifted from dividends to flexible dividends, which is what I call buybacks.
Okay.
The
Yeah. Yeah.
effective
Makes
buyback
sense.
and cut them all out. So I think increasingly around the world, the other thing that this crisis is going to bring is increasingly companies are going to say, why would I want to lock myself into a policy where I have to pay the same amount in dividends in good years and bad years? It makes absolutely no sense. I need more flexible dividend policies. So don't be surprised if that's the other thing that comes out of the crisis is dividends become more volatile and more variable over time, which is the way they should be on equities, to be quite honest.
Absolutely. Understood that, Prof. Uh, the next question comes from Vikas Shah. Uh, while a lot of frameworks, on valuations, investment world, speak about buying a particular security, even sizing, potentially very little thought or little literature is available on selling. You did speak about Tesla selling out at whatever price you did. Again, no regrets out there. Uh, but partially, it's also the odds that the odds of finding a winning company that can keep reinvesting back into business and keep compounding are so low. How should we look at it? Of course, there is a distribution curve, as you rightly pointed out, which says at a particular value, maybe it's gone into absurd valuation theory, and yet there is the scarcity premium angle that maybe there is only one Tesla or there is only one Amazon. Who else can take their place? So how do we kind of marry both of these? Any thoughts on the selling framework from you would be very helpful.
Let's
Thank you.
reverse the science. Think of it as a math equation. Why do you buy? Because the minus you put out, what you pay, is less than the plus, the value you get. Why do you sell? Because the plus you get is higher than the minus. So I bought Tesla because at $180, it was around at the 40th percentile of my value. It looked like there was a 60% chance it was undervalued. I'm sorry, the 60th percentile value. So basically, there's a 60% chance it was undervalued, 40% was overvalued. It was undervalued by about 7-8%. Why did I sell Tesla? Because the price, in fact, that's what makes it tricky. It's not that it's difficult to find a great company. It's difficult to find a great company and not have the market catch up with the fact that it's great. Apple earns well above its cost of capital. But guess what?
Right.
Everybody knows that it earns more than its cost of capital. That's the tricky part, right? It's not just finding a great company, but finding an undiscovered great company that remains undiscovered for a long time. And that's the problem that you run into in active investing is it's a flatter investment world. There used to be a time when you could find a secret company and nobody knew about it for years while you were investing. Today, the very act of you trading gives away the secret. So it becomes much more difficult to keep the secret to yourself. So that's why active investing is so difficult to win at. It's an act of faith in your value, and faith will adjust your value. And I would say, don't view, I think the problem is people buy a stock and they forget about it, because that's what old time value investing told you to do, right? Buy a great company, put in your portfolio. To me, every investment I have in my portfolio needs to be revisited every year, because it has to earn its right to stay in my portfolio every single year. So half of what I do every year is actually maintenance valuation, which is I go back and revalue every company in my portfolio and say, does it still belong? Because if my rule in investing is I should buy something when it gets undervalued, then to be consistent, I should sell the same thing when it's overvalued. The problem is you fall in love with your winners. And then you find ways to justify holding it.
Justify the narrative.
Don't even try to revalue companies that have gone up because they're afraid of what they'll find. I mean, I'll be honest, I did not want to value Tesla in January 2020 because it had done so well for me. I said, maybe I should just leave it in there. But I have to fight that urge and revalue every company, including the companies I love and the companies I hate. Because the other thing people do is they stop looking at the losers. They cover up I don't remember buying that stock. It's still in your portfolio and it's down 50%. Because we know that we hold on to losers too long and winners too long. So sometimes just forcing yourself to be honest with yourself on those investments can lead you to the right judgments.
Well put. Uh, Prof, this question comes from two people, Ishan and Kuldeep. Uh, in one of your recent interactions, you said that if you choose a moral stance, for example, no alcohol, no tobacco, etc., you typically run a suboptimal portfolio, and you should live with it. In that context, I just want to get a sense of ESG. Is it a buzzword, a fad? It seems sustainability, sustenance, etc., is something that we would love to have. How do we kind of marry it? Because that seems to have still done well even during this period. Do we have a higher discount rate? How do we kind of plug in ESG in that kind of framework? Thank you.
I just finished a paper that I co-authored with my good friend Brad Cornell. In fact, our collective editorial showed up on ESG, showed up in the Financial Times today, so we get a chance to read it. Okay. And the title of the paper kind of gives away where I come from, which is, do you want to sound good or do you want to do good? ESG, in my view, is the most overhyped, overpromised concept that I've seen in business history. Because as a company, what are you told with ESG? If you adopt ESG, you're going to become more profitable, more valuable as a company. That's what you're told as a company. As an investor, I've heard people go around and say, if you invest in good companies, you will earn higher returns than you'd have investing elsewhere. So investors are being told that they will earn higher returns. Companies are being told, and there's nothing wrong with and the reason is there's an entire ecosystem making money of ESG. Consultants, I mean, right. Every major consulting firm is an ESG arm. You had ESG specialists, ESG experts. Half of annual reports now, I think, are written by ESG experts. Right. You sound good. But so I went back to basics. I said, I believe in value. So can ESG affect value? Absolutely. Can being good make you a more valuable company? Yes. But for it to happen, one or two things has to be true. By being good as a company, you have higher revenues and higher growth and higher margins. Consumers buy your products more because you're a good company. Patagonia, classic example. But it's a niche company. It it caters to a very narrow market, and it markets itself as a good company. So I'll give you higher revenues, higher growth. The other way ESG can play out is for you having a lower discount rate as a good company. Or put differently, that bad companies end up with higher discount rates. The story there is, if investors will not buy fossil fuel stocks or weapons companies, then the demand will shrink and the returns will go up and your discount rates will have to get higher. The problem with that story is it's at odds with the story you're telling investors, because if that story is true, investors will actually make higher returns,
more money,
buying oil companies. And so my point is, don't go around promising everybody the moon, because it's a recipe for cynicism. And that's what I see playing out, is companies are being extraordinarily cynical on this concept. They sound good. They say all the right things. They've got an ESG specialist around who comes out. It's like a public relations specialist. I know 40 years ago when I started teaching in business school, there were no ethics classes. Now, of course, every business school has ethics classes and ethics cases. Which is good, right? We want people to be ethical. But guess what? If by the age of 30, you don't know the difference between right and wrong, good and bad, there's no ethics class that's going to teach you this. And ask people a very simple question. Clearly, we're teaching a lot more ethics in business school than we did 30 years ago. Here's my follow-up question. Are companies now they're after all run by these people we teach, are they more ethical now than 30 years ago? And the answer is absolutely not. We've converted ethics into another buzzword. And I have a bad feeling about ESG becoming another buzzword. Because in the hands of the people who are marketing it, it is becoming the supreme buzzword, right? Because you have ESG measures, and just like corporate governance, the checkbox measures. You do this, you do this, you do this, you're a good company. You know what the most widely held stock by ESG investors was last year? Microsoft. Okay. And I remember 20 years ago, Microsoft was a Darth Vader of corporations. True. How the heck did Microsoft become the best company in the world? You know why? Because momentum and making a lot of money. If you ask me for a predictive variable on ESG, it is actually momentum. So magically, companies that have done well over the last 10 years become, Is it because good companies have momentum, or is it because companies with a lot of momentum that are doing well can afford to be charitable, can
True.
afford to
So,
put aside? So I'm a cynic when it comes to ESG. When all is said and done, more will be said than done on ESG.
so clearly, selection bias, you think, is it definitely plays through, and
Because the
there's some
research actually
storytelling.
indicates almost no correlation between being good and corporate profitability. In fact, if there's evidence on investors who invest in good companies earn slightly lower returns, and they should be okay with that. Because remember, this is a
And
constrained optimization problem, right? Then mathematically, how can a constrained optimal be better than an unconstrained optimal? So don't
unconstrained.
tell me I can have my cake and eat it too. I cannot.
Understood, Prof. In the interest of time, we're moving into certain personal questions that students have asked, especially as they are going through their courses. So this one is from IMK student Ashish Chinoy. Did something in valuation also teach you something about the way of living life and valuing intangible things? Is there a philosophical bent to valuation to draw life lessons from? A very profound question from a student.
Actually, reverse the question. Do life lessons make you better at valuation? The answer is yes.
Mhm.
Much of what I've learned about corporate finance and valuation, I've learned by looking around, right? I mean, I learned about arbitrage by watching my 4-year-old son um, barter with my 1-year-old, where my 1-year-old used to love coins, and my 4-year-old offered him coins in return for paper money. Hey, you
Okay.
pay a quarter, you get it. There's arbitrage right in front of you. Why does it happen? Because one side of the transaction is less informed than the other, which is the 1-year-old. And I think that I learned about arbitrage and why day trading will never work, because you're going to be trading against people who are more informed than you 90% of the time. You're like my 1-year-old. And over time, you're going to collect a lot of quarters in return for bills. So if you listen to my corporate finance and valuation classes, I talked about arbitrage. I talked about dividends and buybacks. Again, I said dividends are like getting married, buybacks are like hooking up. It's so your life lessons travel into your investing.
Valuation.
So my advice to people is live your life. Watch what people are doing around you. Don't be so caught up in your work that you're caught up in spreadsheets and financial data. Life's lessons play out in investing in valuation, because companies are collections of people. They cater to other people, and I think you need to bring that humanity into everything you do.
Very profound. Prof. The second question comes from Ram Prasad. And clearly, you're one of the very rare opinion makers, who likes to boldly put price targets, who isn't offended or being diplomatic, which most of the investment world typically are, putting this or that on the one hand, on the other hand. You lay out all the assumptions. The question really is, as you set out your investment journey or your teaching career, when did you get this confidence that, you could actually lay it all out? Did it start right from the start, or was it something that you developed along the way? And the second part of the question is, assume you're not the dean of valuation or the guru of valuation, and you're just starting out now. And given what's there in Twitter and the trolls that are there, would you want to do the same way of putting it all out in Twitter, or do you think that maybe now, it's become too hostile and wouldn't want to get there?
The two parts. The first was, I think that I developed the freedom to say whatever was on my mind, because when I realized I had nothing to lose. And that nothing to lose came from a choice I made early in my life. And this was like 1 year into my academic life, that I was never going to be a consultant. I've never consulted in my life. I've never done an appraisal for money in my life. And I'm lucky enough to be able to do it. So I'm not saying this as if I'm Mother Teresa. I was lucky enough that the profession I chose, which is teaching, I'm a teacher first and foremost, paid me enough that I did not have to do any of those things. And that's given me the freedom to say whatever's on my mind. Because if I had at some point in time decided to be a consultant or an expert witness, already my exits would have been blocked off, because then I'd have to worry about, if I say this, what will Goldman Sachs think about it? If I say this, what will so and so think about it? If I say this, will be,
Right.
so I have absolutely nothing to do. So if I think Goldman screwed up on an IPO valuation, I have absolutely no qualms about saying Goldman screwed up on an IPO valuation. This is the worst valuation I've ever seen. So part of it is realizing that if you have the freedom to walk away, you have the freedom to express your opinions. And I tell people, because a lot of my students go into investment banks and consulting firms, I said, be very careful about those golden handcuffs that are going to be put on you. You're going to be paid a lot, but as you get paid more and more and you develop a lifestyle built on what you're going to get paid, you're losing your freedoms, because you're going to think twice about. So you might be in the middle of a deal and you realize the deal is not a very good deal. You get ready to open your mouth and say, this is not a very good deal, when you realize that this might not be the best choice, given the fact that you're part of a deal-making team that needs this deal to go through. Right. So I realize that people, that most people operate under constraints that keep. So I feel no glory about being able to say what I want, because I don't think most people have that freedom. I was lucky enough to be able to have made the choice where I have that freedom. And that freedom allows me to say, this is what I think. You might agree with me, you might disagree with me. And it's also given me, I think, a strength that I would not have if I had an agenda. If people learned that I work for Goldman Sachs or I work for KKR, then everything I say, they will look at through those lenses. He works for Goldman Sachs. What's his other agenda? Hopefully, when people hear me, they can say, look, I don't agree with them, but I also know he does not have an agenda. He doesn't work for Tesla short sellers. He doesn't consult for Tesla. So when I say good things about Tesla or bad things about Tesla, it is what I feel. It's what I believe. And I know that social media is not a space where there's a lot of holding back. And I realized that. And as I've posted on Tesla is a classic example, a company where people have very strong views, I make a point. Look, we can disagree without being disagreeable. You can disagree with me, and that's perfectly okay. In fact, I think I would welcome that. But to disagree with me, tell me. So that's why I often frame my valuations of not this is the valuation of Tesla. I very clearly emphasize this is my valuation of Tesla. And by the way, I want you to disagree with me, and I'll give you the framework to disagree with me. In fact, I welcome your disagreement and how it plays out, because my story and my valuation of Tesla drive my decisions, and your story and your valuation of Tesla drive your decisions. It's not my job to tell other people what to do. And I think that from that perspective, I've been blessed in terms of not having the kind of poisonous atmosphere in social media where I feel the urge to leave. But I recognize that social media is this. So I'm careful about what I talk about. I stay within my lane. I'm not. People don't come to read my post to think about what I think about politics, what I think about the Indian government, what I think about. That's not my job. I'm going to stay in the lane that I came in, and I'm going to continue to talk about what I feel I can have something to contribute about. And the day I realize I have nothing new to say, I'll stop writing. What's the point? Why keep saying? I'm not a newsmaker. I basically take the news and give you what I think I see in that news. And if I have nothing new to say, why say it?
Wow. Absolutely. Wow. The last question, as we kind of wrap up, on constraints of time. This being, from an IIM, just want to get your sense. If you could tell your student version of yourself in 78, 79 as you graduated out of IIM Bangalore, what would be the one personal or professional advice be with the benefit of hindsight?
To thine own self be true. I know it's easily said, but very difficult. There will be choices you have to make in your life. And some of those choices you might not have, you might have to make for financial reasons, for family reasons. But there's only one person you got to answer to at the end of your lifetime, which is yourself. And I think that, that's why I think you don't need ethics classes. You don't need, in a sense, you've got to be true to yourself. And, and it's the advice I give my kids as well, is be true to yourself. I don't want you to be something because somebody else wants you to do it, or what your peer group believes. It's easier said than done, because I'd be quite honest, there'd be times where I've felt the urge to do something because other people want me to do it. But I think that to thine own self be true.
Wow, Professor, truly great 90 minutes. I know I'm not going to sleep tonight sitting in India. Going to ponder about each and every insight that you've shared with us over the course of the last 90 minutes. Absolute delight from the entire fraternity of I am Kozhikode, the students, the faculty, the alumni. Great, great, great thanks for making it today in your very busy schedule. Thank you so much, Professor. Stay safe. Thank you.
Thank you. Appreciate it.